Hello and welcome to this episode of the Bull and the Bear podcast here on moneyandmarkets.com. I'm your host, Matt Clark. Glad you're with us as always. I mean, it's always great when we know we're picking up when new people are subscribing and checking us out on YouTube. And by the way, if you're just listening to this for the first time, you can subscribe to this podcast. You can check us out on Apple Podcasts. We're also on Google Podcasts. We're on Spotify. We're on iHeartRadio. Check out our YouTube channels I just mentioned. You can do that by going to youtube.com and just doing a search for the Bull and the Bear podcast, and we're right there. And you'll find us. You can subscribe to us. We picked up. We're certainly glad to have new subscribers jump on all the time. So it's great for that. If you have a comment or a question or anything like that, maybe you'd like us to look at a particular stock, maybe you can email us at the Bull and Bear at moneyandmarkets.com. That's the Bull and Bear at moneyandmarkets.com. And we're more than happy to do that. But if you go on and subscribe to our YouTube channel or podcast, anything like that, leave us a comment, leave us a review. We'd love to check out your feedback. I hope everyone had a great 4th of July holiday. I know that I spent it just kind of relaxing a little bit. I hope everyone else was able to do a little bit of that, spend time with maybe some friends or family, or cooking out, or going to the lake, or doing whatever it is that you enjoy doing on July 4th. It's a great holiday. Fireworks are great, and even into the 5th, when people are still shooting off fireworks a day after the 4th. Today I'm flying solo, so it's gonna be a little bit of a new experience, but that's okay. I have an interesting thing that I want to talk about, and I came across this yesterday, and I actually have a piece on this on moneyandmarkets.com, so I encourage you to just go to moneyandmarkets.com and check it out. But it revolves around one word. It's one word that in the investment world, in the finance world, we've heard it time and time again. In fact, for the last 3-4 months, it's been a constant word in relation to the market and why the stock market is moving the way it is. And that one word is hope. And you see it all the time. I mean, we write about it all the time. In fact, a lot of times the reason why the stock market goes up is basically because investors are holding out hope for a quick economic recovery. And that's what's pushing the market up. And you wouldn't think that would necessarily be right, considering the state of the economy that we're in and that we're in a recession. But again, as we've talked about before, Adam O'Dell, our chief investment strategist, has mentioned this. I've mentioned it before. The stock market is not the economy. So don't confuse the two. Don't think that one is directly correlated to the other. Now, there are some market movements that do kind of correlate with the status of the economy, but the economy is more backward looking. The stock market is a little more forward looking in terms of, if you want to just boil down to a big difference between the two. So they're not really related. GDP does not have anything to do with stock market movements, very rarely. So, but it's important to understand that this kind of ties together here, in that investors are hoping that either a subsidence of the coronavirus outbreak will or reopenings of states and local communities will push up business activity, thus will then increase our economic fortunes, if you will. And what I've seen in terms of, there's a few things that I've looked at, and I just don't see that happening. I mean, I'm not a naysayer. I'm not a doom or gloom kind of a guy. That's really not who I am, whether it's personally or whether I'm talking about finance and markets. That's just not my mentality. But there's just some unavoidable things that I look at, and it's inescapable to think the way I think about this, and that is that the market recovery is not going to rebound as quickly as we think. It is not going to bounce as fast as we'd like to think it will. I know there's all sorts of letters that you get, the V shape, the L shape, the W, the Nike swoosh, whatever that happens to be in terms of a market rebound. But our economy is not going to work that way. And there's reasons why. And let me first preface by saying, I understand that hope is a big deal. It's a big deal personally, but in terms of investing, hope is not a strategy. Hope is not an investment strategy. You don't invest in something with the hope that it's going to do one thing or another. You have to, do your research, do your homework, or have, rely on like us at Money Markets to do that for you, because we've got your back, and we know what to, we take sound analysis and look at the facts, and then tell you what that means. And that's kind of what I'm doing here in terms of the economy, is I'm looking at certain trends, and I'm seeing certain things, and I'm realizing that things just don't add up. And again, I get that hope is an important thing. You have to have it, otherwise, what are you doing? But when you're talking about investing your money, whether it's $10 or whether it's $10,000, hope is not a great investment strategy. Don't bet the farm on hope, because it's just not. It usually doesn't end well. It doesn't work out. And let me go through a couple things to tell you why I see it this way. And you can agree or disagree. It's totally fine. If you agree, great. Let me know. If you disagree, also let me know. Don't hold back. Don't say don't do anything. If you think, hey Matt, you're wrong, you really don't know what you're talking about, here's why. I would love that. I would love to hear that. I would love to hear that kind of feedback to let me know that, hey, I'm wrong and here's why. I don't take it personal. I have my views. Everyone has theirs. Totally fine. But you remember back in March, okay, and this is when the coronavirus had really started to take a serious toll on the United States, and lockdowns were nationwide. Cities were closed, states were closed. Millions of people, myself included, working from home because that was basically what was mandated. At that point in time, Congress had stepped in and decided to pass a $2.2 trillion stimulus package. And part of that package included, the one-time $1,200 check, from the Treasury to help kind of make sure that money is still in your pocket. Another part of it was an increase of $600 per week in unemployment insurance benefits. Every state varies in terms of their unemployment. It can be anywhere from, 12 weeks, as it is here in Florida, to 6 months in terms of the duration of which you can take unemployment. And the amounts also vary, and there's a minimum and a maximum, and it's based on your income and from the last 6 months or a year or whatever. There's a lot of factors involved, basically. And what Congress did in its infinite wisdom is they decided to add a $600 a week topper, if you will, and extend that out until July 31st. So basically, if you were furloughed or laid off or let go from your job, and the coronavirus caused your business to close down, and your boss let you go or furloughed you or laid you off or whatever, then when you applied for unemployment benefits through your respective state agency, on top of that, on top of whatever you get from the state, you get an additional $600 a week in unemployment benefits. So it actually kind of created an odd situation. We've talked about it here before, in that it created a situation to where even when businesses were reopening, they couldn't rehire their employees because the employees were actually making as much, if not more, in some instances, on unemployment than they would if they went back to the workforce. But anyway, that's beside the point. So you got the $1,200 stimulus check, which most Americans got, based on certain parameters. Not everyone got it, just because it's based on income and tax filing and this, that, and the other. But most Americans did get a $1,200 stimulus check. And there's always intent in terms of what you should do with that. Pay off bills. Basically, the intent for the government is to go out and buy stuff. Go spend your money and buy goods. Go buy your TV. Go buy your new laptop, go buy, whatever. Go spend that money and put that money back into the economy. Saving money is really not what they want you to do with the stimulus check. But, regardless of whether you did or not, it doesn't matter. And the stimulus package added about $3 of extra income for Americans for every dollar that was lost to the shutdown. So it made a pretty significant impact to income values, income levels for Americans. And that's great. And the $600 unemployment insurance, as flawed as maybe the final thinking was in terms of businesses being able to hire, was also good, especially if you're unemployed. If you got let go, if you got laid off or whatever, it's good for you, and that's understandable. But there's a problem, and the problem is that if you look at the monthly change in personal income, December, January, February, up slightly. Then the coronavirus hits in March, and it takes a pretty good downturn. Then in April, you've got this big bump up in personal income, mainly because of the coronavirus stimulus, the extra $1,200 per person, unemployment insurance increases, all this, that, and the other. And then in May, it drops back down again into a loss in terms of personal income. So, you had about a 10.4% boost in personal income in April, thanks to the coronavirus stimulus. But the problem is that, when that stimulus money is gone, there's nothing left. That's it. There's nothing else. So if you've already spent that $1,200, that's it. And as of right now, as of today, there's been talk and discussion about another coronavirus package. The White House wants it capped at $1 trillion. So odds are the prospect of having another payout from the government is less and less likely. Unemployment benefits extensions are probably less likely. We're probably looking at things that are going to benefit directly small businesses as opposed to individuals. So that money runs out, then that's it. And that means that you're pretty much back to square one in terms of your income level when the coronavirus hit. The other factor to look at here is the Federal Reserve. One thing the Fed decided to do was basically take its money printing press and kick it up on overdrive and use those funds to pump into the economy when they first saw distress in March. They put money into the economy to help banks continue lending to individuals and businesses, but banks have reined that in. Banks have reined that in for a couple different reasons. The main reason being is that there are, as of right now, about 100 million customer accounts, loan accounts, and this could be credit cards or mortgages or whatever, they're in forbearance or in deferral. And basically it means that account holders are behind on their payments. And when that happens, banks are going to pare back how much they lend. You become a risk when that happens. You are no longer credit worthy, if you will, or a viable candidate to receive a bank loan. But also on the flip side of that, consumers, us, you, me, everyday Americans are paring back on our debt. We are not taking out nearly as much in terms of debt. We're not taking out nearly as many credit cards. We're not taking out nearly as many bank loans. We're not buying nearly as many cars. We see things on the horizon. And I think the perception is that things may not get any better, especially if you're unemployed or the possibility of unemployment with a second lockdown maybe on the horizon. And you see that as, I don't want to add that extra burden to my personal bottom line. I don't want to go out and add an $800 a month loan for whatever, a new car or a house or whatever, because I don't know if I'm going to have a job in 2 months. I don't know if this lockdown is going to just say that my business is going to let me go, and then I'm stuck. So consumers are paring back how much they're taking out in debt. And this has been a pretty significant drop off since a high point in March to now. It was from 2019 to 2020, it was a pretty steady rise, and that is now tapered off significantly. And you have to understand the U.S. economy is driven in large part by debt. So whenever you see debt lowered by banks and you see consumers not taking out nearly as much debt, that has a direct correlation to the economy. So basically, you see the stock market. The stock market has bounced, but by and large, it's moved upwards since lows in February and March. You have the S&P and you have the Dow that are gaining 35 to 40%. The Nasdaq has already hit its record high in the midst of all this. But those gains aren't going to last. They're not going to sustain, and that is especially true for stocks and sectors that are exposed to consumers and exposed to borrowing. Things like that are going to start to fall back off again. So to bring all this about and the okay, what does this mean for me kind of question? If you're as a smart investor, you want to be looking at certain sectors to possibly invest your money in. And then there are sectors you want to completely avoid. And with the state of the economy and with the prospect of where things are going, there's about 4 sectors I would say you want to avoid right now. And those sectors are banks, because they involve borrowing, travel, because it's kind of discretionary spending, discretionary retail, so any company that specializes in either manufacturing or selling things that you don't absolutely need, and industrial, because while manufacturing data is up, if discretionary retail goes down, that manufacturing is going to start to taper. But if there's a second lockdown, and in some cases there already is, here in South Florida, Miami-Dade County is just south of us here, and it's already imposing lockdown measures to curb the spread of the virus. Texas has also experienced some issues, and we've seen 18 states reach record highs in terms of their outbreak numbers. So this is going to lead state officials, local officials, to want to pare back the restrictions on lockdowns. But there are some sectors that, as an investor, you want to look at because they can benefit from this. And I say that, I almost kind of feel bad when I say taking advantage, because you take advantage of a bad situation. But as an investor, let's look at the numbers. You look at what's fact. You don't let emotion drive where you're going. You don't, emotion and hope don't drive the boat when it comes to investing. It should be, it should be homework. It should be analytical. It should be technical. It should be, very fact-based. That's what should drive your investment. And in terms of that, consumer staples are going to be huge. They were before. We saw how consumer staples grew back in March when the coronavirus lockdown had its first iteration. Consumer staples went through the roof. Technology has been kind of the buoy of the entire stock market at this point. Technology stocks have pushed the Nasdaq to a record high, and it's because of how solid technology stocks are. I'm not saying you should invest all your money in that, or you should just dump everything into technology, but let's be honest, technology has performed very well, and even before the coronavirus, technology was doing very well. So now it's just continuing to move upward. So those are the two sectors that I think that you really want to take a look at when and if we reach a second lockdown. And again, you want to avoid banks, travel, discretionary retail, and industrial. They're just ones that, as Americans, are the fear of losing money, whether it be because you've already spent your $1,200, or your unemployment benefits are coming to an end, or basically you just don't know what your job situation is going to be like in the next month or two. Then you're not going to spend nearly as much money. You're not going to go out and you're not going to buy a new laptop. You're not going to go out and buy a new car. You're not going to go out and buy a new TV. You're just not going to spend money on those things. You're going to buy what you need, not what you want. So discretionary retail is just not a great sector to look at, and that leads to industrial. But if you look at things like discretionary staples, cleaning products, toilet paper, things like that, all things that make up that area. That's what you need. That's not what you want. That's what you need. And people are going to continue to buy that. They will, it may not necessarily be the most expensive, but they will find alternatives, cheaper alternatives, and they will still buy it. And technology is going to continue to rise, even if there's a second lockdown. But one thing in closing, what I want to let you know is that, here at Money Markets, we're led by, our chief investment strategist, Adam O'Dell. And he knows his stuff, and he doesn't use emotion. He uses fact. He uses it to be it's a very technical process that he goes through, and it's provided great returns for those who have followed him. And you have myself, I do the same thing. I look at the numbers. I look at the facts. I use my investigative journalism background to look at facts, not at conjecture, not at theories, not at, what may be, what may not be. What are the numbers telling me? What do the numbers say? What does the data tell me? And using Adam's proprietary stock rating system is great to be able to really hone in on potentials there. But one thing I want you to know is that, we're doing our homework here at Money Markets. We're not just throwing things out there just to see what sticks. We're doing our homework, and we're looking at things with a very, very clear eye. So I want you to know that in terms of the podcast, or in terms of the website, or whatever method you're looking at, it's not just fluff. It's not just for the sake of doing it. We're actually looking at things because we want to make sure we're giving you the safest, most sound, information that's fact-based that we can give you. And that's really my parting message right now. I appreciate everyone who tuned in, who downloaded today, and who's tuned in before. Again, we're on Apple Podcasts, we're on Google Podcasts, we're on Spotify, iHeartRadio. You can check out our YouTube channel. Just go to youtube.com and type in the Bull and the Bear podcast right there. Leave us a review, leave us a comment or a question. We'd love to read your feedback. If you do have a comment or question, something that maybe I've said that sparked something in you, then by all means, let us know. Email us at thebullandbear@moneyandmarkets.com. It's thebullandbear@moneyandmarkets.com. So certainly glad that you listened today. We'll be back on Friday. I will have contributor Charles Sizemore and Chief Investment Strategist Adam Odell on. And we're going to talk about some stocks. Don't know what we're going to talk about yet, but I'm probably not going to give Adam a heads up because I want to see if he can think more on the fly. So again, for all of us at Money and Markets, stay safe, safe investing, be smart. Let us do your homework. Check us out. We're more than happy to give you information that is reliable and fact-based. So until next time, certainly hope you all have safe investing, and we'll talk again on Friday.